context, why companies do M&A, and then we'll move into more practical how to do M&A. So with no further ado, so I think Aparna has done a very, very good intro. I am Australian. I've lived in Singapore and worked in Asia for more than 10 years. I have a combination of investment banking and corporate advisory experience. And for those of you that are founders, I have walked in your shoes. I have built and exited companies, and I've been an investor successfully and unsuccessfully in companies as well. So I guess I bring a somewhat unique perspective of having been on both sides of the table as a buyer, as a seller, as an operator, as an investor. So I hope my perspectives are useful to you. First thing we're going to look at is a little bit of the M&A landscape in Southeast Asia. And I'm not going to dive into a lot of these numbers, but the theme that I probably want to convey to you here is that there is a growing volume of mergers and acquisitions activity in Southeast Asia. And that volume of activity is going to increase, I believe, quite dramatically over the next 3 to 5 years. When you look at the number of actual deals that are done in comparison to the number of funding deals that are done, there's a big gap there. So there's lots and lots of companies that have been funded, that are growing. We've got, give or take, about a dozen or so unicorns in Southeast Asia now, and we're going to see more and more mergers and acquisitions activity. What's kind of interesting when you look at some of these stats is the stage at which companies are being acquired. And this, to a certain extent, underlines a point I'll make in a moment about the size of transactions. So you'll see here that in terms of this stat on the right, the majority of companies that are being acquired, their previous round of funding was Series B, a few, but mostly Series A or even seed stage. So companies are being acquired mostly at a relatively early stage in their evolution. That's a good thing. But one of the things that we will see as the market matures, as companies grow to be more mid-sized companies, is we will see more and more activity of around later stage companies. When we look at where it is happening, it's kind of no surprise in some respects that Singapore domiciled companies make up the bulk of the acquirees. Part of that is something that may be well known to many of you, which is that for a lot of investors, it is preferable if they are investing in companies that are actually based in perhaps Indonesia or Vietnam or Myanmar, Philippines, etc. There's a very clear preference for investors to have a Singapore holding company as the top co for receiving the investment. And as a consequence of that, you've got a lot of companies where they may actually be operating in other markets, but they're technically Singapore companies because of the holding company structure. What you may also notice from looking at these stats is, particularly the lower one, is that there is quite a lot of acquisition in country and in Southeast Asia, but in fact there is a greater amount happening outside. So that is acquirers, which is the blue box, acquiring companies in the market. So if you look at the fact that you've got the blue boxes collectively add up to a lot less than the grey boxes, what that tells you is there are a lot of companies that are being acquired by acquirers outside of Southeast Asia, which again is a promising sign for the future. Some stats on particular transactions. Again, I don't propose to go through these exhaustively, but there is quite good data on deals that are happening, and there are deals happening on a pretty regular basis, including, I might add, during the COVID-19. Unfortunately, a lot of deals don't have the details of the acquisition value, the transaction amount announced, so they're undisclosed. part of our stealth work as advisors is to try and reverse engineer transactions and work out what the actual amount of payment was. Sometimes we can do that, sometimes we can't. But you must, I think, look at this and get a sense that there is a regular volume of activity happening. If we look at what is going to happen, kind of want to draw a bit of a picture via a graph here. So here is a little diagram that describes the long tail and the short head. This would be a kind of a picture that I'm sure many of you would be very familiar with, this notion of the long tail. In this particular context, we're looking at the dimensions of what are the companies worth on the left side and how many companies are there on the bottom. So this is not an absolute, prescriptive shape of this curve, but it gives you a sense that there are a relatively small number of very valuable companies. There are a few in the middle, and there is a long tail of many thousands of early stage companies. That's as the market is today, and as I look at the market as I've seen it over the last 10 years, and that's changed, the evolution that we're going through, and particularly the one that will happen over the next 3 to 5 years, is the bit in the middle will get fatter. And this is a good thing for everybody, because that means there will be more unicorns, but potentially there will be many more mid-sized companies. And by mid-size, I'm talking about companies that have got an enterprise value of perhaps 80 million to 500 million. Above 500 million, they're really at the top end of valuations and large companies in this market. And below 80 million, they're often pretty small companies, even with a pretty healthy valuation. And so I guess one of my crystal ball gazing forecasts is that we're going to see many more of the companies that have been funded over the last 2 or 3 years, with the very significant amount of venture funding that's been in the market, emerge into companies that will be in the centaur range. And this is something that will drive a lot of the M&A activity in the market. So in summary on this kind of point, I see over the next couple of years that for those of you that are founders that may be thinking of either buying or selling, notwithstanding that we're in difficult market conditions now, but that they will improve, that the next 2 or 3 years we'll see a very strong market for M&A in Southeast Asia. Now, having said that, one of the things I'm very conscious of in these types of presentations where there's a lot of information, a lot of slides, is it's hard to remember the key points. So I'm going to help you a little bit. There will be four of these little buttons that will emerge through, and I hope that these might be the key takeaways that you can take from this program. So that's a little bit of where we are today and where I think we're going. Let's now talk about the role of mergers and acquisitions. And I want to talk about this principally because for founders that are in the Series A, Series B stage, they've got good, strong growth. As I meet founders and talk to people in the market right across Southeast Asia, a lot of founders have no experience at all on mergers and acquisitions. And at this point, I should say, Aparna, we should run the 2 polls, because this is one of the questions. So we're going to run a couple of quick polls. If you can please answer those. Here's the first one. And just to give us a sense of who you are. And let's just have a quick look at those numbers. Yeah, so we've got a mixture of founders, investors, and interested others. That's great. Thank you for your very quick responses. So got a good sense of that. Now we're on the second one, and this is about your knowledge or experience in mergers and acquisitions. So let's just run that one, please, Aparna. It's coming. It's coming. All right, so while that's on its way, I'll just keep talking. Here we go. Are you interested in this webinar because? please give us just a sense of what's out there, or who you are. Very good, very good. Yeah. So we're seeing, yeah, excellent. Okay, thank you. So yeah, there's quite a few of you that either are currently thinking about M&A or have actual experience, but equally there's a lot of you that have no experience in this area, and that's fine. This is about mentoring and helping you all understand. So, back to the slides. So the role of mergers and acquisitions is as one of the mechanisms for growing companies. It is, for large companies, a very everyday activity, and we'll look at some examples of successful M&A in a moment. And by way of example, we'll talk about Google for a moment. Google globally acquires in the order of 30 to 40 companies a year. It acquires lots of small tech companies because they have some magic piece of code. It acquires all sorts of businesses. So in very large corporates, the role of M&A is as a core capability. And McKinsey, in one of their books of wisdom, talks about a strategic capability, and that companies that are good at M&A end up having an edge that their peers and their competitors will really struggle to replicate. So the role of M&A is really around helping transform a company's trajectory, accelerating growth rates and the path to scale, and changing competitive dynamics. So let's look at some examples of that. And probably for me, one of, in the last roughly 25 years of the internet sector being around, probably one of the best deals ever done, when Google acquired YouTube back in 2006 for $1.65 billion. Now, many of you would not remember that acquisition, and you may not have been across the announcement of it, but at the time, that was seen as an extraordinary acquisition by a still relatively young tech company called Google that had only IPO'd a couple of years before and was still in its relatively early growth phase. And they spent what was seen to be a huge and often unpredictable amount of money on this funny little video company. Now, today we can look back some 15 odd years later and with hindsight, which is always perfect, say genius. I believe 2019 YouTube contributed something in excess of $10 billion in revenue to Google, or to Alphabet, the Google parent company. And so that's a clear example of strategic M&A at a very early stage that's panned out very well. Another example, and this one somewhat more recently and a much bigger price. Again, Facebook paid a big price to acquire WhatsApp, which even today, only 4 or 5 years later, still looks pretty expensive. That's a very big check. But at the same time, as we all know and understand, Facebook and WhatsApp and Instagram, those three businesses together, are undoubtedly now the global leader for audience. Who has the largest audience on a day-to-day basis across those three platforms? Facebook does. So there's some big deals that set the scene, but I also think it's highly interesting, and this will come back to some of what's going to happen in Southeast Asia. Some years ago, I think 5 or 6 years ago, Microsoft was in its evolution towards cloud and towards mobile. And for many of you that have been in the tech sector for a long time, you would know that this has been a very painful journey for Microsoft to evolve from its old desktop installed software business to a cloud-based and a mobile-based future. Satya Nadella, again, a very, dare I say it, genius in his foresight, understood that he could not afford to spend 3 or 4 years going from a desktop model to a mobile model. And they acquired a very early stage 2-year-old funky email company called Acompli. And it was, in the day, again, 5 or 6 years ago, one of the leading email apps for a more contemporary user experience. And again, as I'm saying to you today, I'm sure you'll be going, yes, swiping left to right in my email app and being able to scroll up and down, Well, 5 or 6 years ago, that was not the contemporary model. And so that was a strategic acquisition. And lo and behold, not long after Microsoft acquired Acompli, they rebranded it as Outlook for iOS and Android. They've continued to iterate it. And that has been a core piece of the puzzle for Microsoft to develop what is today a very contemporary cloud and mobile offering for its suite of software. So there's some great stories of success, but you can't have the good stories without the bad. And just as companies fail because they don't have a sound organic growth strategy, or that strategy is not executed well, poorly executed, poorly devised M&A can also be highly unsuccessful. And I'm not picking on this particular company, but it kind of stands out as probably one of the greatest lack of success stories. And that was News Corp globally acquiring MySpace for $580 million in cash. Now, today, of course, we go, MySpace? Where did that go? It went nowhere. And I won't prosecute that case very long, other than to say you can see across these examples how good M&A really transforms a company's trajectory and can change competitive dynamics. And when it's not done well, it doesn't achieve those things. Let's, and just, so there's, your second takeaway, transformation of your trajectory, changing competitive dynamics. But let's now bring it down to a little more practical stuff. Why do you do M&As? So fundamentally, there are 2 strategic drivers. There are many complex strategies, rationales, but they fundamentally come down to 2 issues, and they are capability and footprint. Capability is all about an acquirer having a puzzle and they don't have one particular piece. It's about a decision often about, can we build this? Should we build this? Or is it just better if we just go and buy something? And there are a lot of considerations if you're a large corporate where, if I take the Microsoft Outlook iOS and Acompli example, somebody like Satya Nadella could not afford to wait 3 or 4 years for Microsoft to build a mature, really contemporary iOS email app or Android email app. So that was about speed to market, complexity. And so in capability, what you're fundamentally buying is a piece of technology that you don't have, people that have experience and sector knowledge. You're buying intellectual property. You might be buying licenses. And so that's all about adding something to your mix that you don't currently have. Whereas footprint is all about market access and acquiring customers, revenue, maybe a brand, maybe it's a partner network. It's all about accelerating growth and achieving scale and potentially blocking competitors. So let's bring that into reality and look at 3 or 4 good examples. So first of all, 2 examples that I think speak to these things where announced earlier this year, Grab acquired a wealth management SaaS technology platform. The founder, Chandrima, a wonderful CEO and founder. And that was a business that had built out a retail wealth management white label SaaS platform so that banks and financial institutions who wanted to be in retail wealth management would be able to deploy that platform. Now, in the context that I'm talking about in terms of capability, all of this is public information or guesses on my part, could pretty clearly see that at senior level, Grab had made a decision strategically that it needed to be in retail wealth management. The ability to sell financial services products to its hundreds of millions of app users around Southeast Asia. Grab did not have that capability in-house, and potentially they could have spent time to have built that type of technology, or in this case, they could buy a company, rebrand it, Grab Invest, and then go to market, as I'm sure they will do in due course. So that's a good example where strategic decisions are made around a capability that needs to be brought into the company. Another example in the footprint camp was, not that long ago, late last year, Carousel announcing its acquisition and merger with 701 Search, which was majority owned by Norway's Telenor. So this was all about 701 Search having a particularly strong footprint in the Philippines for general classifieds. I'm sure you all know Carousel. In terms of a marketplace for buying and selling goods, new and second-hand, it's in a very competitive market. It competes both at the local level with local marketplaces, as well as the big regional competitors like the Shoppies of the world and the Lazadas, etc., etc. So that is an acquisition which, again, from the outside with no inside knowledge, you can look at that and go, okay, that's about extending Carousel's footprint to give them a step up in their competitive position in the market. So they're two examples that cover the pure either capability or footprint. But the reality is most M&A is often about a combination of those two things. So let's look at another example. Gojek, again, announced earlier this year acquiring Mocha, a payments company in Indonesia. A combination of capability in terms of Mocha having point-of-sale technology, payment services, sales and inventory tracking, management, loyalty programs, as well as a very significant footprint of merchants across Indonesia. So again, strategically a very smart acquisition to both bring in-house some capability they didn't have, as well as extend their footprint. Another example, and I won't wave my flag all that often. It's not about me, it's about the mentoring. But this is a particular deal that I was involved with in 2019. So this was a merger. So this was not an acquisition by a larger acquirer. This was a merger of two similar-sized payments companies in Vietnam who merged. They had a common shareholder that made the merger relatively easy. And that was all about bulking up to improve their competitive position. And rebranding, so you now have a company called NextPay, which today can lay claim on the merchant side in Vietnam to have the largest network of merchant acquisition points in the country. So a real step up in their competitive position. So that's some of the bigger picture stuff. You've, I guess, heard a little bit now about the need for a very clear strategy, execution, which we're now going to move into, and then the integration part. And just to give you a sense,